Hello and welcome to our tax year-end planning webinar for taxed clients. Hopefully you can see our screen. We've got a lot of tax strategies, tax planning topics to cover in the next 45 minutes to an hour. But we want this to be interactive. So for those of you who are live watching it at the moment, please do ask any questions. We want to be able to cover off various tax planning tips as we go through it. For those of you that are watching this on the recording, unfortunately, you may not be able to ask any questions, but feel free to also drop us an email and we'll be able to support with that. Now, we've got a couple weeks until year end. So myself, Tom, and Joe, we are here to talk a little bit about what you can be doing in the next couple of weeks to plan ahead, what investments you could be looking at, what allowances you should be using up as well. And we're going to cover a range of topics. So we'll get straight in. Just a short introduction. As many of you may know, I'm Arj, one of the founders at Taxed, and I send you a lot of emails regarding these webinars. But our aim really is to make tax easy using technology. I'll pass over to Tom.
Thanks, Arj. Yeah, hi everybody. Thanks so much for giving up a bit of your day to hear us speak. My name's Tom. I'm head of personal finance at Octopus Money. Octopus Money, in a similar way to Taxed, if I'm honest, are really here to try and make advice and financial planning accessible and simple to absolutely everybody. In history, financial advice really used to be reserved for those who had over £500,000 to invest. The nature of Octopus Money is that we are here to help anybody, regardless of wealth, regardless of background, all the way across the kind of wealth sphere. My history is as a chartered financial planner, and have worked across a couple of different tech companies like Nutmeg and a company called Wealthsimple, but now happy to speak for Octopus Money for the next hour or so. Over to you, Joe.
Thanks, Tom. Yeah, looking forward to this one. We only really kind of get to do this session maybe once or twice a year. It's that time of the year as we kind of transition from the end of one tax year into a new one, and we get lots of questions around what people can be doing to kind of be more efficient and whatnot. So looking forward to it. I'm sure there's probably a few people here on the webinar that I've spoken to personally, but for those that don't know me, my name's Joe. My role is the tax lead, which is predominantly kind of it means that I'm kind of working with our clients from mainly a personal tax perspective, from self-assessment stuff, but also for the more complex tax planning and stuff. So started my career at PwC and the same team as Arj, spent around 10 years in the Big Four environment, and then moved to Taxed. So yeah, looking forward to getting into it.
Awesome. Thanks, Joe. Thanks, Tom. So let's take a look at some of the different year-end tax strategies that we like to talk about, and we'll be going through some of the case studies, examples, and various tips regarding some of these strategies. And I split this into two different kind of buckets. One, all around reducing income. So expenses, if you're a sole trader, a landlord, a business owner, even employees, a little bit more strict if you're an employee, but expenses are super key to reduce your income. We've then got things like kind of pension contributions, which I'm sure many of you already know about. We do kind of bang on about pension contributions quite a bit, as well as structuring. So looking at how you're structured or your investments might be structured. It could be yourself if you're working as a contractor, employee on a fractional basis, or it could be your investments if you're looking to invest in properties, etc. Salary sacrifice as well is a great option and often very much overlooked. And we've got an example as a case study a bit later on, and just how much salary sacrifice can actually save you, looking at things like electric vehicles, cycle to work, etc. And then we'll be looking at tax relief. We'll be covering things like venture capital schemes, and ensuring that you use up allowances in terms of individual savings accounts. We won't be covering leaving the UK tax residency because it's a little bit more tricky, but if you do have plans to leave the UK, it's always a common topic for us at Tax. We are well versed in expat international tax, so any residency cases are great for us, but also certainly a tax strategy that we're seeing more as the world is more global. Finally, offshore bonds as well, other things to look at, and top slicing relief. Anyway, we'll jump into some of the main part of the webinar. But before we kick off with some of the tips and the case studies, just want to highlight that the highest effective tax rate in the UK goes all the way up to 71%. So let's take an example of an individual earning 110k and they've got a student loan. They could be facing, let's say they get a £10,000 pay rise. They may only see 2.9k of that. Now, the reason I wanted to highlight this is because for me, it really frames this whole discussion in terms of what we should be thinking about. At what points are we entering these tax traps where actually we're not seeing much back for our additional work, for the additional responsibility? And tax isn't everything, but some of these tax rates are quite high. And I remember we were doing some research on this, and there are certain cases where you might actually be worse off with a pay rise. For example, if you've got childcare vouchers, etc., and if you earned from 99k, you don't actually get a pay rise until you earn over 109k. You almost need a 10k pay rise to actually be net in a positive. So certain cases like that, super important to look at, to review. And I think that brings us nicely onto our first tip and some of the planning when it comes to self-assessment tax year end.
Yeah, exactly. Thanks, Arj. And funnily enough, on that example you had on the previous slide, I was talking to someone just yesterday about this who has a newborn child, paid about £116,000, and really panicking. What year do HMRC look at? Is it this year for his earnings? And then there's a mad scramble over the next 2 weeks to try and get more money into a pension to get below the 100,000. So it can be so brutal. And I think really linked to this message that I'm trying to kind of land on this slide, that with Octopus Money, we've worked with like 160,000 different customers, and there is such a theme with tax year end of it's just panic and rush to be like, oh my goodness, I've not really thought about it this year. All of a sudden I need to take action, and I've only got, sometimes it feels like you've got 2 weeks left, but sometimes companies actually only accept payments up until the end of March because it takes five days to clear. And then there is also then this mad rush just before the 31st of January when it's your kind of self-assessment filing if you're someone that files a tax return. And all I would say is having some form of a financial plan ultimately removes that stress and removes that panic that you have in the days before this. And you can start to really appreciate that actually, okay, the actions we take over the next 2 weeks will inform what we do on just before the 31st of January next year, which in turn informs what you do in April again. And so all of these kind of touch points are linked. And for anyone who is feeling like they often have a stressful week or two running up to this, really think about potentially creating some kind of plan so that you can tie your actions to future goals or circumstances. And so we find that really alleviates a lot of the stress that comes with it, which is just one thing keeping in mind.
Awesome. Thanks, Tom.
Of course.
So yeah, that leads us nicely onto our first tip, which really is, somewhat of a basic tip and is kind of echoing all of the things that Arj and Tom have just sort of mentioned there. So kind of 3 things on the screen there that, at this stage, not just this stage of the year, but, probably throughout the year, you sort of want to be understanding and checking in on these things and understanding your numbers, income levels, and all of that sort of stuff. So, firstly, kind of goes without saying, but you as you're kind of going through the year and getting towards the end of the tax year, you want to understand what your total income is looking like, especially if you are kind of earning over £100,000, because as the year goes on, if you are kind of edging closer to £100,000, you're expecting a bonus. You may tip well over that £100,000 mark, and so knowing that in advance is obviously kind of going to help you sort of plan, whether that's before the end of the tax year or after. And it is, a very common one. I see lots of people that kind of get bonuses and stuff fairly late in the year, or some equity, which really kind of takes them from way below sometimes 100k and right above it, because it can just depend on the amounts, right? But that can be a surprise. So obviously understanding your total income. And also for self-employed people as well, what your current position is looking like, can help you with making decisions around pensions and whatnot. And that therefore kind of links to your tax rates and stuff. So again, going back to what Arj said, you obviously want to understand whether or not you're a 20, 40 or 45% taxpayer. That is key, because typically any relief and some of the investment stuff that we're going to talk about, any kind of tax relief that you're able to attract through any type of investment is, broadly speaking, going to give you tax relief at your marginal rate of tax. So it's important to understand, if you're going to put money into a pension, we often say to people, not that it shouldn't happen, but if you're a 20% taxpayer, you may not really see any tax relief. If you're a 40% taxpayer, you're going to see a bit more tax relief at your 40% band. So understanding your rates is going to help you to obviously understand how much tax you're going to pay, but also where you might be able to attract the most relief. And then the last one, we've already touched on it, but the dreaded kind of, the tax trap, which Arj mentioned, is, are you in it or are you about to go in it? Again, it all kind of ties into what we've said. But, if there are ways, and I think we'll talk about how tax isn't the be all and end all, but if there are ways that, you can kind of prevent that happening, going into the tax trap, in a way that works for you, obviously that is a good planning point. So yeah, that is tip number one. Understand where you're at. Hopefully obvious, but hopefully it helps. And then linking to that, then, or the next kind of step from that would be, okay, how do I kind of potentially reduce that taxable income or attract that tax relief? And here really is where we'll talk about, I guess, the classics. And when I have conversations with people, the first one that comes to mind really for me is pension contributions. And for me, there's a there's a number of benefits to that, right? Because it does give you tax relief if you contribute to a pension. And we've got a case study on it, so we'll talk about it a bit more. But also, you're saving for the future, and with a financial planner, they will hopefully kind of help you with the best products and stuff like that, and help you get the best growth on that pension. So you are kind of saying goodbye to the money for now, but it's something that is, I'm going to say that people don't see it as very sexy, right? Pensions, but actually, I think there's a lot to be said for it, and of course, it can help you get you below the 100k mark and all of that sort of good stuff. Similarly to that, you've got gift aid, so that's charitable donations. So if you make contributions to a charity and you're resident in the UK, you always pretty much want to make sure that if you go for that gift aid, it's going to give you a bit of tax relief. If you're a 40% taxpayer and you've made some charitable donations, put those on your tax return, you will get additional tax relief. Salary sacrifice. Now, a lot of pensions can be and will be salary sacrifice pensions. The example that we've got isn't a salary sacrifice pension, but if you are under a pension scheme with your employer that is salary sacrifice, it quite literally, what that means is it reduces your taxable income. It reduces the number that would be on your P60. So if you're earning 100k and you decided to put 10,000 pounds into your pension, P60 in theory should show 90,000 pounds. You are literally reducing the amount of income that you're taxed on. So that, for me, often is the most efficient and the easiest way to kind of get that tax relief, because you get it through your payroll, basically, without having really to do any more work. But there are other examples, and we've got an example on this about how you can use salary sacrifice for a couple of different things, right? And the key ones would be electric vehicles. If your employer is sort of providing one, and there's a scheme in place, you can actually reduce your taxable income by, taking out an agreement with your employer for an EV, and cycle to work could kind of work in exactly the same way. Lastly, consider your allowable expenses, both for employed and self-employed people. As we've said, if you're employed, it's a little bit harder to just kind of deduct loads of expenses. Can get quite confusing. For the most part, you can only really claim allowable expenses for travel to a temporary workplace. That's not reimbursed by your employer. But professional fees, I think a lot of people maybe miss those. If you have to kind of pay annually for professional fees and stuff like that, that's always going to be deductible and would kind of slightly bring down your taxable income. So these are probably all of the basics. I always start with people on these before we kind of go anywhere else, is like, have you considered these things? So tip number 2 there is think about these ones in terms of how you can, initially reduce your taxable income. And just to demonstrate this then on a couple of case studies. So this is your pension one. And now just to be clear, this is a pension that is not salary sacrifice. So just because your pension isn't operated under salary sacrifice, and another tip I would say here is do find that out with your employer if you're not sure. It isn't always the clearest thing in the world to understand whether your pension is salary sacrifice or not. There are pension schemes in place where the kind of pension comes out of your pay actually after tax is deducted and has a very different kind of operational treatment. But this is somebody who is in that second example, sort of category that I've mentioned there, who either has a pension that is not salary sacrifice or has her own private pension. Now, the way that the tax relief works is basically what would happen is if you contribute to a pension plan, it extends your basic rate tax band. It's kind of difficult to visualize, but your basic rate band is the 20% band before you become a 40% taxpayer. And that's £37,700 broadly speaking. So if you contribute £10,000 to a pension, your basic rate band would be extended by £10,000 to £47,000 for somebody who is not in a salary sacrifice scheme. So in this example, Sarah's earning £110,000. So she's over the 100k mark. She's starting to lose her personal allowance, and in this case, she's lost £5,000 of the tax-free allowance. Now, although it works in a different way, by putting some money into a private pension separately to her employment, it is going to reduce what's called her adjusted net income, which is a number that kind of is behind the scenes and really is just determining whether or not you're going to get the personal allowance. So in Sarah's case, where she contributes £8,000 to a SIP, a self-invested pension plan, 9 times out of 10, that is, or more than that, there will be a gross up on the way in, because HMRC deems that obviously you've made that contribution net of tax. So when it goes in, you normally get tax relief straight away on the way in by way of a 20% top up. So based on the 8k that Sarah's paid in, the amount that she's actually deemed to have put into her pension, or has put into her pension because of the top up, is 10k. She gets tax relief on the £10,000. And long story short, because of the 2k that goes in on top of the £8,000 and the 40% tax saving that she gets on that investment, she's saving herself £6,000, and she's also getting her personal allowance back. So can be kind of fiddly. What I would say is, when it comes to pension relief and kind of modeling that, for anyone who's looking at that now, our software has got 26 self-assessment calculations are up and running. You can't submit yet, but you can use that to start modeling and seeing how much tax relief you would get on pension contributions. That's case study 1. Case study 2 is a little bit different, and perhaps one that I'm sure some of you have seen it, but actually really kind of shows the power of a salary sacrifice, even if it's for something that isn't a pension. So the EV, apart from maybe savings on petrol and stuff like that, isn't going to be an investment per se. But it really shows in this example how you can save quite a lot of money and get what may be considered a good deal by using your gross salary before tax is deducted to go into an EV, right? And it should be noted that you wouldn't be able to do this with like a petrol or diesel car. So HMRC allow this specifically for EVs. And just in the example on the right hand side, the number that I would focus on really is actually the gross income that you need to fund this kind of arrangement. So James, in the example, is able to kind of sacrifice £500 per month, which from his net, after tax is deducted, or I should say from his gross, what we've got to consider is that he has to pay that. If it's not with his employer, he's got to pay that after he's already paid tax on the amount. So broadly, what it would mean is that is over £14,000 of his gross income needed to pay for a car or an EV outside of a plan with his employer. However, if he's able to salary sacrifice it, it's literally just £6,000 from his gross salary. The reason that number is so high, the £14,000, is because James is a 45% taxpayer, and so to actually get to the same point from his gross pay is £14,000. So by sacrificing his salary, obviously he doesn't have that salary anymore. So let's make that clear. He is sacrificing that to go towards the EV, but he saves tax and national insurance on that at 47% here. So it's nearly £3,000 he saves there. There is a benefit in kind charge, much lower than what it would be for a normal company car that is not salary sacrificed. It's about, I think it's going up, but at the moment in the example is 3% of the list price of the car per year. Means that your benefit in kind value on your EV would be £1,350. Tax on that 45% is £600. So when all is said and done, quite a long-winded kind of way of getting to it, but James is going to be saving thousands and thousands of pounds by getting a car that is an EV through his employer due to the power of the kind of salary sacrifice schemes here. So something a little bit different in terms of, we always talk about pensions and salary sacrifice, but if people are thinking about this, you are going to, in an example like this, you're going to be better off doing it through an EV salary sacrifice scheme with your employer than you are getting the money, paying tax on it, and then going separately and getting a deal with a kind of a dealership separately. So hopefully that kind of helps to frame that a little bit. Which leads us on to tip 3, which I think is more again on the basic side, right? But kind of the obvious ones here in terms of £20,000 ISA allowance. That is changing. I'd have to check whether it's next year or the year after, but it is changing to £12,000 can be invested as cash and the rest has to be invested as like stocks and shares. So you've got £20,000 for this year, and you've got a few days, to put some money into an ISA if you haven't used your allowance. And the thing about the ISA, I'm sure we're probably already aware, but any income that ISA generates, whether it's through stocks and shares or normal cash ISA, is completely and totally tax-free. And so, it might take a little bit more time, but by putting in £20,000 a year, you can slowly build that ISA up, and slowly it can generate more and more income for you. So if you haven't used that allowance, we typically recommend that that's a good option. It's worth noting on pensions, we talk about it a lot. You have got an allowance of up to £60,000 per year that you can put in. So 2 points there really is don't make sure you ideally don't go above that. You do get carry forwards from the previous years. I won't go into too much detail on that. But you get up to £60,000 a year that you can put into a pension. That is gross, and that is a combination of your personal contributions and your employers. But if you're kind of, getting towards the end of the year and you've got enough of your allowance left, potentially think about utilising that. And then you've got allowances for capital gains tax, trading and investment allowances and stuff like that. So there's, on top of your personal allowance, which I think is very widely spoken about, you get £3,000 annual exemption for capital gains tax, which sadly has decreased quite a lot over the years, but you still get £3,000 on any profits that you make from assets tax-free. You get a trading allowance if you're self-employed, up to £1,000 per year is tax-free. And then you've got investment allowances or savings rates. So there's £1,000 for basic rate taxpayers on interest that you can get tax-free. Does reduce slightly depending on your rate of tax. Dividends, you can get up to £500 tax-free. So, I guess before people start thinking about all the other wonderful types of investments that may be out there, I kind of always talk to people about these basics. Have a look at these and see where you are on all of this stuff. Kind of maybe once you've looked at that, then it's, you can think about, other investments and whatnot. But yeah, that is it really for kind of the first few standard tips and case studies.
I think you did a pretty good job, Joe, of keeping pensions sexy there.
I think so.
that
Yeah,
worked.
I think it's sexier than people realise. Yeah.
And what I would love to talk about next is really hammering home the original reason for pensions, because as Joe said, such a powerful tax planning tool, and they can have a really marked impact on your tax bill in the current tax year, in the next tax year. But really important to remember that the kind of sole purpose of pensions in the long term is to provide an income for you in retirement. And as a nation, unfortunately, we are under savers when it comes to retirement. Now, a couple of generations ago, there was this thing called a final salary pension, where you didn't really need to think about retirement that much. Ultimately, you would stop working, but your company would carry on paying you an income until you passed away, with these incredible things called defined benefit or final salary pension schemes. Unfortunately, in this day and age, they're very, very rare. And so the onus is absolutely on all of us to build a pension pot to enable us to retire at some point. And so there's this amazing double benefit of pension contributions of reducing tax bills today, but also setting money aside for our future. And I wanted to kind of note that these are figures provided by the Retirement Living Standards of how much income a retired person needs at 3 different levels. And something to note here is that the bare minimum in the eyes of Retirement Living Standards is that for a single person, you need access to about £13,500 of income per year just to cover the absolute basic needs. If for a couple, that's just shy of £22,000 per year. And the thing I always like to say here is most of us will be hopeful that we'll have a state pension in our future. If we have 35 qualifying years of national insurance contributions, we'll get a full state pension. At the moment, that's forecast to be about £12,000 per year. And so immediately there is a shortfall between state pension and the minimum income that we need. And so it's imperative that we actually do make ongoing contributions into pensions. Now, if we want to get towards the comfortable level, which for a single person, that's about £44,000 worth of income per year, or for a couple at £60,000, immediately you can start to think we need a sizable pot to complement any state pension income that we have. And so for that comfortable kind of standard, at age 60, that's going to be anywhere between $1 million to 1.5 million needed to be held in pensions, depending on rates of return and lots of assumptions. For a moderate, you're probably going to be looking at trying to get close to £500,000 held in a pension pot. And so just trying to keep that in mind while we're focusing on short-term tax liabilities, but also thinking longer term that at some point, maybe retirement isn't the cliff edge where we stop working altogether, but ultimately it's important we have a bit of choice in later life, and having a well-funded pension pot can give you that. So really important to keep in mind. If we head on to the next slide. And another way of kind of saying this is a classic phrase that many financial advisors will use is not letting the tax tail wag the dog, of solely focusing on the tax bill, what could be at the expense of your wider finances. For example, as Joe said perfectly, huge upside from making pension contributions in the short term, but ultimately under current rules, that money is then not accessible until age 55, soon to be 57. And so again, the point here is that a financial plan is massively powerful to understand the trade-offs of decisions that you make. So you're knowing that you're mitigating short-term tax, but also providing for the future. And as kind of a sneak peek, this is exactly what the Octopus service does. It kind of helps you to forecast out your life based on a number of different scenarios, and then gives you all of the recommendations to actually achieve those financial goals in the future. And I'm sure we'll come on to it, but as kind of customers of Taxed, you do have a reduced kind of cost for this Octopus Money service that will become apparent. But we always think it's important to think about these tax planning opportunities in the kind of context of wider life. Next slide.
100%. Thanks, Tom.
Of course.
And I guess with regards to tax planning, kind of moving into a slightly different case study here looking at structuring, but still super important. And it's something that I guess is a little bit more year round, but worth mentioning today as we head into tax year end. Now, we're looking at an example here of CJ, who is a technology consultant who is considering contracting. And this might be a case where, let's say, someone is employed, but looking at more of a fractional role, looking at working with multiple types of clients, so outside of IR35. And in these cases, the actual revenue or the income might be slightly different, a full-time role with kind of benefits, etc., versus a contract role, which often you can charge a little bit more because it's would need to factor in lost employment benefits and more strict conditions. But looking at just an example here where we take the revenue of 110K within a limited company outside IR35 or within IR35, so employed, we can then see a massive saving when it comes to the actual take-home pay. And this is 7K saved if an individual is going to be paying themselves a salary of 12,570. So it's assuming that there's no other income for this individual. For CJ's case, 12,570 is paid from their company to themselves as a salary. So that's also a deduction for corporation tax. So it will reduce the tax that the company needs to pay. And as you may know, that will be the amount of tax-free income in your personal name. So 12,570 tax-free, and then the rest of it we're taking out as a dividend. A dividend is a payment from a company to an individual, to shareholders, that is always done after corporation tax. So it's with the retained profits within the company. Now, we would normally recommend paying 12,570 as a salary and take 37K as a dividend throughout the year, which brings you to 50K total income in your personal name. And then the rest of the income you can keep in the company. And then you've got the flexibility with how you take it out. In this example, we're going to take all of it out as a dividend, but I think it's a good example of how much tax can be saved. You've got the flexibility. It's hard sometimes to showcase a case study here because within a company, you can choose what you want to do. If you want to put money straight into your pension, you can do that as a gross employer contribution, which reduces your corporation tax. And obviously there's no income tax until withdrawal as well. So it gives a few more options. Where we see this really quite attractive, I think, is where people, as they get a bit older, they start to do consulting kind of gigs on the side of their work, or that becomes their main work. And as they're getting a bit older, they're looking to maximize their pension contributions. So hitting that £60,000 pension allowance as they look to retire in the near future. Question there, just in terms of what is IR35, apologies, it's a bit of a tax acronym. Essentially, IR35 is legislation which, as Joe mentioned, where an independent contractor providing services should actually be deemed employed. There's a few different things that HMRC have as various kind of tests. So if you are only working for one client, for one contractor, then they may deem that to be actually you're employed. If you're using their assets, if you have to come in between 9 to 5, you're almost seen as an employee. But let's say that you're working for multiple clients, you've got your own laptop, etc. You may be classed as self-employed and outside of IR35. Perfect. And if anyone has any questions on that, we're always here to discuss either the IR35 side of things or even the whole structuring. It's also quite good if someone is currently a sole trader and looking to move into a limited company as well. Perfect. So I guess this comes into the actual kind of tip itself, is just to plan your structure. So we looked at a case study of moving into contracting, but structuring is also important on a wider level. It's not just your employment, your work, but you can also look at it for your investment. So if you're a landlord, potentially look at utilizing a limited company for that additional rental income, there will be lower tax rates. Mortgage interest is fully deductible instead of the 20% tax credit now in the UK. And you have the flexibility. You can choose whether you want to take money out today if you want to enjoy that income now. You can choose to keep the retained profits in the business, potentially move overseas. If you're living overseas and you're taking out a dividend from a company in the UK, there may not be any tax on that, or any UK tax on that. So there's a few different options there. It gives you more flexibility. And also look at other investment wrappers. We've mentioned ISAs, also offshore bonds, family investment companies. These are all various strategies that can help you to move things out of your personal name, because when you've got assets in your name and income in your name, you have to declare it, you have to pay the tax on it. Whereas if you can move things into a separate entity, it gives you that flexibility. And some of the key questions that we ask our clients when we're having these advisory discussions is, do you need that income today? If you don't need the income today, you have the flexibility, you can keep it in the company or put money into your pension, etc., then potentially structuring is a good option. What are your long-term goals? Are you planning to retire soon? Are you planning to invest in 10 properties, 5 properties, just 1 property? Or some clients of ours might be accidental landlords. Then it's probably not worth setting up a limited company structure. But if you're looking to grow your portfolio, have a think about those long-term goals. Finally, what are your other sources of income? Because if you've got income in your personal name, that's where it's almost even more important to ensure any additional income. You want to try and keep that separate where possible, especially if you're hitting some of those higher tax rates and tax traps. So keep an eye on your other sources of income and see where you stand. And then finally as well, just not on screen, but if you are landlords looking to structuring and various other options, are you planning to use mortgages? If you're using mortgages, then a limited company structure can be quite efficient, as mentioned earlier. And there's also other options in terms of partnerships and setting up a deed of trust to split income. So if you've got a co-owner, you can split that income. It doesn't just need to be on a 50-50 basis. You may split that 90-10 depending on your other sources of income. So a few different things to think about there when it comes to structuring. Perfect. We'll now take a look at venture capital scheme. There's a few different venture capital schemes. You've got SEIS, EIS, VCT, SITR, but we're going to take a look at SEIS in this example. SEIS stands for Seed Enterprise Investment Scheme. Essentially, it's a way that HMRC and the government want to incentivize investing in early stage startups. And SEIS is looking at very early stage. So these might be businesses that are under 3 years old, but the tax relief is good, is quite nice. You get 50% of your investment back when you make an SEIS investment. So as an example on screen, we've got a £20,000 investment, which means Lisa, in this example, gets £10,000 back from HMRC, and that's tax that she's already paid through her employment or through her capital gains. So she'll get that 10K back. And there's also CGT reinvestment relief. So if you've got capital gains, can also look at seed enterprise investment schemes for relief on your capital gains. There's also special relief on EIS as a deferral relief. So a few different things here. And also, if the actual investment fails, which, to be honest, to be transparent, many of these early stage startups will fail, you only lose 17% of your investment, because you also get income loss relief at the time of the asset failing, of the investment kind of reducing to nil. So a few different forms of tax relief there. You get the income tax relief, capital gains tax relief, and loss relief as well. Finally, there's also inheritance tax relief on this as well. So I think there was a big push towards pension contributions as a method of keeping things outside of IHT, outside of inheritance tax. And now SEIS is one of those new vehicles that allows you to do that too. So yeah, in this example, just on the right hand side of the screen, we've got Lisa, who is earning 120k. So the tax on that is around 40k. I think it's like 39 something. So let's say 40k, and then we've got CGT at 24% on 40k. So that brings a total tax bill of 49k, and that's where a 20k investment can see tax relief of around £12,500. So instantly, what's actually being risked is £7,500, but you as the individual investor have £20,000 worth of shares in one of these companies, or it could be multiple. For a bit of background as well, we at Taxed, we raised investment through the SCIS scheme back in 2022, and a VC invested in us, Q Ventures, and all the individual investors are then able to claim tax relief. So there's a few different ways of doing this. You can invest directly into a company, or you can also invest into an SCIS fund, which will then do the due diligence and invest on your behalf. So a few different options there, and can be quite attractive. But I think we would almost always recommend to look at the other options first. This is certainly a more high risk, high reward. But personally, I like it because it's all about tech and tax and risky. Lovely. So I guess this brings us on to final sections, really, around how we can help. And as Joe mentioned earlier, using Taxed is a great option. Taxed, we have released the 25-26 tax return, so you're able to model your tax situation. If you've got your March payslip or your last rental statement, or if you're self-employed, you've done your last invoices, you'll know how much you've earned in the last 12 months. You can model your tax return, and in tip 1, know your income, and then start to plan based on some of those case studies and things that we were looking at. And then also we are doing one-to-one strategic review tax planning sessions. So specifically looking at from a tax perspective, what can we be doing to support? And Octopus Money, Tom, should I pass over to you?
Yeah, of course. Yeah, so as I mentioned before, any attendees or customers of Taxed have a reduced fee for access to Octopus Money. You can scan the QR code on the screen, or equally, there should be an email coming out, I'm sure, very close to the end of this webinar. But if you ever find yourself in a situation where you're not really sure about the long-term impacts of any of your tax planning options that are in front of you, or if you're not really sure if you're building for a retirement that looks comfortable, or if you're just not really clear about that you're optimizing all areas of your financial life, that is exactly why we are here. We won Advice Firm of the Year last year as well, which we're pretty chuffed with, and part of the Octopus group. So if we can help, we will definitely try.
Awesome. Thanks, Tom. And final part is just in terms of those venture capital schemes, Q Ventures, the VC that had invested in us, they have also mentioned if you'd like to have any introductory calls to discuss venture capital schemes, the SCIS fund, for example, happy to have a chat through with them. So we'll send across some of those links, but if you do want to get in touch with just any of these aspects, feel free to send us an email, and we'd be happy to point you in the right direction, but also look out on your inbox. I guess any questions coming through the chat?
There's a question there on taper relief, which I think is probably referring to when your annual allowance tapers for pensions, and whether or not you have carry forward relief and stuff like that. I think that may be what that's referring to. So that's not in the software because it's based on quite a few factors. So it would be, we can definitely advise on it. I would just say reach out to us and we can kind of have a look at that, and sort of understand exactly what it is that we might be able to do, and scope it out. Can be quite quite a complex exercise.
Thanks, Joe. Any other questions at the moment? I guess if there are any questions for those watching it on the recording as well, feel free to drop us an email and we'll be able to cover things off. Tom, Joe, any final any final points as well?
No, I don't think so. I think, yeah, try and make the most of the next couple of weeks before tax year end. Have a look at your latest pay slip. It should have kind of running totals in the bottom right-hand corner, so you can have a good sense as to how much tax you've paid, what your income is going to look like, how much you've paid into pensions, and then try and make use of the next couple of weeks, I'd say.
Agreed. Perfect. Oh, just got a question here as well. Need to look at setting up a SIP or SAS. Can I pay into SAS from self-employed income? Yes, the SAS is a self-administered pension scheme. I believe it works in a similar way to a SIP. But yeah, should be able to. Happy to discuss that one in more detail as well. Perfect. Thanks, everyone. Hopefully this webinar was useful and covered some of the tax planning tips as we head into the 5th of April tax year end. But yeah, happy to chat through with anything if there are any further questions. But for now, thank you very much for watching either live or on the recording. Thank you.
Thanks all.